Have you ever wondered who's really getting paid when the financial system collapses, when banks fail, when governments step in with trillion-dollar bailouts, when companies go bankrupt? There's a hidden hierarchy that determines who walks away rich and who loses everything. And here's the thing, the game has always been rigged. There's an ironclad rule that decides who gets paid first, second, and last when everything falls apart. And if you're not at the top of that list, you're basically screwed. Let me show you exactly how this works. Let's go back to 2008. The worst financial crisis since the Great Depression. Banks were collapsing left and right. Lehman Brothers went bankrupt with over $600 billion in assets, triggering a complete market meltdown. The Dow Jones dropped 777 points in a single day. People were panicking, pulling their money out of banks, and the entire global financial system was on the verge of total collapse. But here's what most people don't know. Even in that chaos, there was a very specific pecking order for who got paid. When the US government stepped in with the $700 billion Troubled Asset Relief Program, also known as TARP, something fascinating happened. Shareholders of failed banks, they got absolutely destroyed. Bear Stearns stock went from $180 down to $10. Shareholders lost between 90 and 100% of their investments. They were wiped out, gone. But you know who walked away just fine? Bondholders. The people who had lent money to these banks got protected, while the people who owned shares got nothing. This isn't an accident. This is by design. There's something called the absolute priority rule, and it's the fundamental law that governs who gets paid when a company or bank fails. Think of it like boarding an airplane. First class boards first, business class second, economy last. Except in this case, we're talking about your money, and most people don't even know what class they're in. Here's the hierarchy from top to bottom. At the very top, secured creditors. These are typically banks and lenders who have a lien or collateral backing up their loans. They get paid first before anyone else because their debt is backed by actual assets. If you default on your mortgage, the bank takes your house. That's a secured debt. In bankruptcy, these guys are first in line and they almost always get their money back. Next up, priority unsecured claims. These include things like unpaid employee wages, certain tax debts, and administrative costs of the bankruptcy itself. The law gives these claims special status for public policy reasons. Society needs workers to get paid and governments to collect taxes, so these debts get bumped up the priority list. Then we have general unsecured creditors. This includes bondholders, vendors, suppliers, credit card companies, and anyone else who lent money without collateral. They're in a much riskier position. They only get paid after secured creditors and priority claims are satisfied. And here's the kicker. In most bankruptcies, there's not enough money to pay everyone, so these creditors often get just pennies on the dollar if they get anything at all. And finally, dead last are the shareholders. If you own stock in a company that goes bankrupt, you're at the absolute bottom of the food chain. You only get paid if everyone else, every single creditor, gets paid in full first. And guess what? That almost never happens. Shareholders usually get completely wiped out. This is why during the 2008 crisis, when Sweden had a similar banking collapse back in the 1990s, their government made a crucial decision. Shareholders were wiped out, but bondholders were protected. When distressed assets were sold later, the profits went to taxpayers. Sweden actually made money on their bailout. But the key point is, the hierarchy was maintained. Bondholders got paid before shareholders. Fast forward to 2023, and we saw this play out again with Silicon Valley Bank and Credit Suisse. When these banks collapsed, shareholders lost about $43 billion. They were completely destroyed. But here's what's wild. The Federal Deposit Insurance Corporation actually protected uninsured depositors, people who had more than the insured limit in their accounts. That protection cost taxpayers billions. The shareholders gone. Preferred equity holders lost 7.3 billion. But certain creditors protected. Now, let's talk about the 2008 bailout specifically because this is where things get really interesting. The government didn't just hand out free money. They took equity stakes in the companies they rescued. When the Treasury bailed out AIG with $80 billion, they received senior preferred stock and warrants. What does that mean? It means the government got paid before almost everyone else. Common shareholders saw their value diluted by 80% overnight. Their stock became almost worthless, but senior bondholders and creditors of AIG, they got paid in full. The same thing happened with Fannie Mae and Freddie Mac. The government put them into conservatorship, injected $200 billion, and took senior preferred stock. Shareholders were diluted by 80%, but their senior debt holders, protected, made whole, got every penny they were owed. Here's the brutal truth. In a crisis, the system protects creditors, especially senior creditors and bondholders, at the expense of shareholders. And there's a reason for this. Bondholders are often pension funds, insurance companies, other banks, massive institutional investors with enormous political power. When the government talks about protecting the financial system, what they really mean is protecting these large creditors from taking losses. But wait, there's more. After the 2008 crisis, regulators introduced something called bail-ins to avoid future taxpayer-funded bailouts. The Dodd-Frank Act created a new framework where, instead of the government bailing out a failing bank with taxpayer money, the bank's own creditors would take the hit. Equity holders get wiped out first, then subordinated debt holders, then senior unsecured debt holders. This shifts the burden from taxpayers to investors, which sounds fair, right? Except here's the problem. Even with bail-in rules, the hierarchy stays the same. The people at the top, the secured creditors, still get paid first. The people at the bottom still get destroyed. The game is still rigged in favor of whoever is highest on the priority ladder. If you're holding common stock, when a bank fails, you're toast. If you're holding senior secured bonds, you're probably fine. So, what does this all mean for you? It means that when the next financial crisis hits, and there will be a next one, the same pattern will repeat. Shareholders will panic and sell at massive losses. Junior creditors will fight for scraps, but senior creditors, the big institutional players, will quietly get paid in full while the rest of the world burns. The system isn't designed to be fair. It's designed to protect the people at the top of the creditor hierarchy. And unless you know where you stand in that hierarchy, you're playing a game where the rules were written to ensure you lose. That's the cold, hard reality of who always gets paid behind the scenes.